Hey, what's up guys? Omar here, broker and CEO of Alden Mortgage and Ome Realty. So a big question that I always get is, can you buy a house with zero down payment? And the short answer is yes. The long answer is going to be the rest of it. Now, in the midst of all of this, you're probably looking for a house. You're trying to go ahead and see, hey, how do I go ahead and purchase a house with zero down payment? What are the requirements? These are all questions that majority of people have. So why not hear it from an actual broker's mouth? The mortgage broker that does majority of these, I do a lot of these. I'm gonna go ahead and explain some of the things that you need to look out for, some of the things that might cost you thousands of dollars if you're not like very, very cautious about, because these are things that only we know. Majority of you do not know. I don't care if you've bought at least, 10 houses. You're still not gonna be as inclined in the world of mortgaging and real estate as, like, for instance, I am, because you're 10. We do like at the highest, at peakest, we do like 50, 60 loans a month. That's 50, 60 different transactions every single month to your 10 that you've done across your whole entire lifespan. Now you kind of get the gist of it a little bit here and there, but as a whole, you're never gonna understand. Now, we're gonna go ahead and first start off with the mortgage rate update and why it's really important to get to know these mortgage rate updates. And if you do wanna keep up to date on daily mortgage updates as far as my company is concerned, that guy right there, Alden Mortgage, just like, subscribe, comment, all that other stuff. Keep yourself up to date, because it'll never hurt to know whether it's now, whether it's in the future. And not only to mention that, my mortgage rates, what I'll do is I'll compare my mortgage rates to the national average. My rates are much different, and this is one of the ones that you're gonna have to do. So before we get into the zero down payment program, let's get on with the mortgage rate update. 30-year fix will be sitting at 5.60%. 15-year fix will be sitting at 5.05%. 30-year high balance will be sitting at 5.55%. DSCR, which is a debt service covered ratio loan. This is a loan product in order for you to go ahead and use the rental income coming in to go ahead and offset the debt, principal, interest, tax, insurance, and other running costs on a property. That's going to be sitting at 8.70. Bank statement loan. This is another one of those non-qualified mortgages where you don't have any W-2s, no tax statements, no pay stubs, nothing. We're just going to use your bank statements to go ahead and qualify you, to approve you. That is going to be at 8.6%. FHA 30-year fix will be sitting at 5.10%. 7.6 adjustable rate mortgage will be sitting at 6.04%. USDA 30-year fix will be sitting at 5.13%. VA 30-year fix will be sitting at 5.10%. And hard money fix and flip. You see a distressed property, you want to go ahead and fix it. You think you could go ahead and turn a little bit of profit. You could go ahead and get that loan. It's usually a short-term loan. You don't want to do that a long-term. You want to get in, get out. It's a wham, bam, thank you, ma'am type of situation going on there. But the national average, now I pulled this up as of December 7th, as of today, okay, I went ahead and on a website, okay, there's this website that's called Mortgage News Daily, which they compile majority of all of the mortgage rates across the board and take an average of it. Average, my 30-year fixed is sitting at 5.60%. The average is sitting at 6.29%. 15-year fixed is sitting at 5.05% with me, and it's 5.72% national average, so on and so forth. You could kind of do the comparison on your own time, and you could go ahead and go from there. But that's really important. That's number one. That's the first step in understanding that shopping around for a mortgage lender, a mortgage broker, a bank, a credit union, I don't care who you get it from, hopefully it is through me. And if it is, if you do so happen to get a loan estimate, a locked loan estimate, so whenever you go, you get a loan estimate that gives a breakdown of exactly the items you're shopping for, that you're allowed to shop for, the items that you're not allowed to shop for. It gives you your rate, your payment, all that other good pajazz. At least let me try to go ahead and beat your bank. Whoever it is, let me try to beat it, because all at the end of the day, it's just going to be money in your pocket, okay? So, for up to 50% commission rebate on purchasing your home, 0% listing on selling your current home, or any of the mortgaging products I just listed, link in the description below. But there's two different types of down payment assistance programs. So these are things that are called piggy banks, piggybacks. So these are going to be secondary loans which is a down payment assistance. A down payment assistance typically is a non-forgivable secondary loan that you pull out to go ahead and offset the 3.5% that's required by FHA. Majority of the loan programs that do down payment assistance are going to be through FHA. There are a few that go on the conventional side because conventional does 3% down, and we do have a couple of people that do that. And let's not be mistaken between a down payment assistance and a down payment grant. Now, a down payment grant is forgivable. This is allotted money that is set aside by each county, each city, each state. Certain times you have to go out and find one. I'll be more than happy to find one for you if you are interested at any given time. But those are really important to know. So down payment grant, forgivable. Down payment assistance, not always forgivable. And the reason why you should always ask for a mortgage broker assistance. Now I'm going to go ahead and pop this guy up for you, okay? This is a scenario to make you understand, because as mortgage brokers, as lenders, I don't do this anymore. I used to, but we always have great ideas. We have amazing ideas, especially when it comes to you purchasing a house or you refinancing, whether it's going to be one of those non-prime products, whether it's a Fannie Mae, a Freddie Mac, FHA. We have something else like this, for instance. Loan amount, $200,000. Term, 10 years. Amortization, 20 years. Rate, 7.5%. Adjustable rate mortgage, 5.5. You, even a seasoned buyer, will not understand this at all. You will not get this. If I could go ahead and present to you, because what we do, okay, well, not me anymore, okay, because I like to try to explain. That's why I do this video, so it's informational. What majority of people do is just to make sure that the business is rolling, we have great ideas to get people approved. That's what we do. We have an epiphanies. We go ahead and see, okay, at this time right now, we're in December, we're going to go ahead and do a buy down because we could go ahead and get you into a home through a buy down. We're going to go ahead and do this ladder program, which is going to be a 10-year amortized over 20 years, and it's going to be an adjustable rate mortgage at it's going to be at a 5.5. So you will not understand this. Me, I could go ahead and break this down to you. I could let you know that it's going to be $200,000 for a duration of 10 years with a balloon payment at the 10 years, termed out over 20 years to reduce your payment. Rate lock for the first 5 years at 7.5%. In 5 years, will adjust to the current value and will be locked for another 5 years.
What he said?
Now, see, I could read that and I could tell you that's exactly what it says. You, on the other hand, will not be allowed to go ahead and, you're not going to okay, I just misused my words. It's not going to be that you're not allowed to. It's going to be that it's harder for you that you don't know how to read certain things to understand what's going on. And by the 5.5, they're actually missing one more number because it's a 5.5, fixed 5, then gets adjusted 5. Then where's the cap on that? Majority of adjustable rate mortgages have cap. Now that I've completely lost you, now that you're completely out of there, let's simplify this and a little bit more. Now that we understand that there is a difference between a down payment assistance and a down payment grant, now you're going to go ahead and want to buy a house, right? You want to go ahead and purchase a house. Where do you start? Number one, you never go to a real estate agent first to go ahead and start unless you know a real estate agent that works with a broker, a lender, somebody that could tell you exactly how much you could afford. Which on the other side, I'm going to tell you how you could go ahead and calculate how much home you could afford. Now, the first thing that we do is we have ratios, okay? You're going to have something that's called a front-end ratio. A front-end ratio is going to be your total housing expense. That is going to be your principal, interest, taxes, insurance. That's going to be how much the ratio cannot exceed past. Now, for instance, on the Fannie Mae, right? On Fannie Mae, it is 36%. Pretty self-explanatory, right? If I took an even number at $10,000 and I did 36% of that, my front-end ratio will be at $3,600. Part two of this, the biggest problem that a lot of people do have is that they think that I should just go to the max threshold of what I am able to afford. Now, your $10,000 a month will not be at $10,000 a month take home because we do not calculate your total taxes. We do pre-tax income. So whatever you brought home is not what we calculate. We calculate what you're paying. So if you made, let's say, $100,000 and you live in California where you're paying between 30 and 35% tax rate, well, that's a lot of money. That's $35,000 that you have lost, that we are qualifying you based off of that $35,000 that you've had. Now then, the same thing goes for the back-end ratio. If you are making $10,000 a month, that's $120,000 a year pre-tax, your total debt to income on Fannie Mae, which we have two big selling corporations that we sell to, which is Freddie Mac and Fannie Mae. And then I'll go ahead and dabble into FHA too, because FHA is one of the big key factors on this down payment assistance and down payment grants that will allow you 100% financing. That is going to be a total back-end ratio of 45%. 45%, which means that you take all of your payments, your credit cards, everything that's on your credit report, right? Everything that's on your credit report, and you compile it with the total amount that you have in your housing expense, and you go ahead and do that. So if, let's say, you make $10,000 a month, $10,000 a month at a 45% ratio, your total back-end ratio is at 45%. Now that's going to be the same thing on Fannie Mae. That's going to be the same thing on Freddie Mac. It's going to be 45%. Typically, we want to see between 33 and 36%. That's where we kind of typically want to see. The lower, the better. Obviously, it's going to be the best case scenario. But you're probably watching this video because, you know what, down payment is a little bit difficult. Now, down payment is really, really difficult. The average time it takes for somebody to go ahead and compile 20% to put down payment on a house, I think I will double check this, but I believe it's about 18 years. To do 3.5% is about 7 years. So if you don't even want to deal with any of that, then yes, you could go ahead and do that. Now, the reason why FHA typically is the one that we go to is because FHA, unlike the 45% debt to income back-end ratio that we have on the Fannie Mae and Freddie Mac products, well, FHA is a little bit different. FHA goes up to 56.99% back-end ratio compiled. Now, is that where you should be at? No. It's definitely not where you should be at, because we are actually only supposed to go to, let me go ahead and get my numbers, at 45% on that too. Typically, we want to go ahead and get at 43%, but you're going to be at 45%. Now, the reason why we even say 56.99% is because that is going to be encumbering with all charges, all origination fees, everything that is associated with an FHA loan, because FHA loans are a little bit more expensive. You do have, the damn insurance, mortgage insurance that you have, and it's just a bunch of other things, upfront mortgage insurance that you have that kind of combines into FHA. Now, with FHA and Freddie Mac and Fannie Mae, one thing you need to understand is that anybody can do FHA. Anybody can do FHA. There is no income. It's not a first-time home buyers program, and it's not something that only first-time buyers could buy. Anybody could use it. There's no income gap. There's no, there's nothing that will deter anybody from getting any one of these products. If you want to put the lowest down payment, obviously conventional is going to be the best way to go to, because you actually could go at 3% on a conventional versus a 3.5% on an FHA. Now that we went ahead and did all of that, and you understood that your ratios are all dialed in, you learn how to calculate your own ratios, see how much house you could afford. Now that you know how much home you could afford, now you work with a lender. Your lender, if they have a broker that they deal with, a real estate realtor that they deal with, now you could go ahead and look for that place that you have. Now, the next steps are going to be a little bit different, because I'm going to go ahead and base the whole entire process. Now, a real estate agent will go ahead and negotiate the terms and conditions of the purchase of the property. That's what they'll do. And as soon as that executed purchase agreement is done, once again, the lender comes into play. So the lender is the beginning part of it, and then they're going to be the end part of it. After they do the negotiated term and they have that executed purchase agreement, then what we do is it gets sent back on over to us. Now there's nobody else involved except us, unless we need to renegotiate a certain clause that was put into, into the purchase agreement that we didn't see in the beginning and we ended up seeing afterwards. or appraisal came in all weird or funky, or whatever happens. So this is the timeline. So as soon as you go into contract, we are going to go ahead and run our AUS again, which is called an automated underwriting system. Automated underwriting system to make sure that we still fit under the guidelines, because guidelines are like, they're like equivalent to asking my wife what she wants to eat. It always changes and she's never sure about it, right? It always changes and nobody ever knows exactly when the parameters are going to stay. But as a benchmark, that's kind of where we stay at. So we run AUS again. Once we run AUS, then we go ahead and submit the file to underwriting. We are going to go ahead and send the documents over to you. Typically, if it is somebody that's worth a damn, they're going to go ahead and send it to you with a DocuSign. I hope nobody's doing paper anymore. That'd be really weird if somebody did. Now, this is what's called an ITP. You have 3 days. 3 days to go ahead and sign all the docs that say, yes, I agree to this rate, I agree to this, I agree to this loan term, I agree to all of this stuff, whether you do a locked rate, whether you do an adjustable rate, whether you do a 30-year, a 25-year, a 15-year, whichever you decide to do, you have to agree to these terms. Once you do that, beforehand, we should have already gotten all your docs. We should have got your W-2s. We should have got your bank statements. We should have got your pay stubs. We should have got your source of down payment. Now, here's another thing. If you have a down payment, just know you are allowed to go ahead and have somebody gift down payment over to you. It doesn't matter who it is, as long as we get to source the person that they are actually giving the gift over to you. Now, wholesalers, they have something that's called overlays, which we sell to. We sell to wholesalers, right? We package it all pretty, make it all look nice, and tell a story that makes sense for when an underwriter looks at it. They're like, okay, I understand this guy makes this much. This is how much this is how much debt he has. I could go ahead and cross-reference his credit report to the total amount of liabilities that they put in, and everything makes sense. The whole story as a whole makes sense. Okay, I know that you're hypothetically the dad is giving $20,000 as a gift down payment for this house, blah, 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 right? So you're able to go ahead and gift it. Now we have to source majority of everything. Now the thing that I talk about overlays is when wholesalers say, okay, we need to know how long that money was in that account from this gift source to go ahead and make sure that this isn't like, I don't know, you don't have somebody that's doing, I don't know, like the cartel is giving you a down payment. I don't know how they're figuring that out. In my opinion, who cares? If somebody's giving you the money, it's not your bank statement that we have to worry about. It's somebody else. Who cares where you're getting from? But sometimes these are little hiccups that during the time that you are going to go ahead and get approved, this is what you want to go ahead and look for. Then, once we got all of that, then we're going to go ahead and get the first touch by the underwriters. The underwriters are going to go ahead and let us know exactly where we're at. Simultaneously, what we'll do is we'll open up title, we'll open up escrow, and we'll go ahead and order the appraisal. Now, FHA, just so you know, FHA, now to go ahead and piggyback off of this to the down payment assistance, because the majority of this video is going to be on how you could get a home for zero down payment, is going to be when we do calculate the down payment assistance. If you are getting a down payment assistance, because remember that for the most part is non-forgivable, we have to calculate that into your ratio. That means that make sure whenever you're doing this by yourself, you're doing this at home, you're doing this with your Mrs. or Mr. or whatever it is that you are, or by yourself, make sure you guys go ahead and calculate the amount of down payment you are looking for to the amount that you are able to qualify for to the purchase price of the house. So if I lost you there for a bit, I apologize. I kind of do this. I do this so much that sometimes I forget that I'm trying to explain this like the best of my ability. But you know what? If you have any questions, comment below. I'll be more than happy to answer it. If something didn't make sense, please, by all means, comment below or my contact information, shoot me an email. I'll be more than happy to answer any of the questions. But after we go ahead and do that, calculate the down payment assistance into your mortgage payment. So if you're doing 3.5% at, let's say, a $200,000 house, doing what, $7,000? $7,000 will be your down payment assistance. So just calculate that. That's still going to get amortized over 30 years too. And by all means, remember, whenever you're doing FHA, you're going to have to refinance out of an FHA because that insurance is going to stick with you, that mortgage insurance. is going to stick with you for the term of your loan. Get out of it. Conventional side, it falls off. FHA does not fall off. So now that we have ordered appraisal, we have open title, we have open escrow, and by all means, remember, just because I say I got a title and escrow company does not mean that you should not shop around different title companies to get the best rates that you possibly can. Because every single title and escrow company aren't the same. One escrow company might charge you, I don't know, $500, and another one will charge you $300. $200 is a lot of money, especially if it's your hard-earned money, and buying a house is incredibly expensive, super duper expensive. Now that we got all of that all dialed in, hopefully we made a package that the underwriter understood from the very beginning, and he clears all of our conditions on the lending, on the mortgaging side, and we don't have to worry about anything. The only thing that we worry about is going to be something that's called a CPL, which is a closing protection letter, that is going to make sure that if there are any cloud on that title, which means if there's any encumbrances on that title, if it means that if somebody has a mechanic lien or something on that property, that we have a closing protection letter that just that says that, you know what, title did their due diligence, they told us everything about it, there's no liens on this property, there's nothing, this is free and clear, we are good to go. Once we get that CPL, we're going to go ahead and get the chain of title. The chain of title just gives a history of the property. Typically we only need 36 months, but you know, on the safe side we go 5 years. That's giving you too much information. Sorry about that. But as you go on, then escrow is already open. We get all the banking information from both sides. Once appraisal comes in, and fingers crossed, especially when it comes to FHA, because FHA is such a pain in the ass sometimes. Once appraisal comes in, you're all dialed in. Then what we do is we get an email that says you are CTC, clear to close, which is the best email that any mortgage lender could get. Any mortgage broker will tell you, once we get that CTC, we're like, thank God, everything is done and over with, we're good. Once you get that CTC, that does not mean you're going to get the keys to the house. That means we are going to go ahead and now coordinate with title. And when we coordinate with title, we're going to go ahead and send somebody out, at least here in California. Okay, I don't know if your state might be different. I don't know how it is in every single state. But here in California, we will go ahead and send a title rep, a notary public from the title rep to go ahead and sign, because we need wet signatures on all the docs that we need you to go ahead and sign. Once we go ahead and sign those, you still don't get your keys. Now we did the wet signing. What we do is we could do a dry funding, but we have to go ahead and wait till it actually gets funded. But when we wait till it gets funded, that's when we will go ahead and tell you, we will tell your real estate agents, both of them, the buying and selling side. And if we have the information to the seller too, we'll tell everybody that, okay, this is the date we are going to get, we're going to go ahead and close, and you get your keys. That's how you get a house for zero down payment. And I hope I explained that correctly. I hope that I did my due diligence on this. And if you like the content, please like, subscribe, comment. And if you want up to 50% commission rebate, 0% listing on selling your current home, or any mortgage assistance, link in the description below. Or you don't even have to do any of those. If you have a question, or if you want me just to look over something, I don't know, maybe you have like a cousin's friend or something like that does mortgaging, and you just want a second opinion, by all means hit me up. Well, I got nothing to lose. It doesn't mean anything to me for me to go ahead and give a second glance over. And then that's always a good thing to do. A good practice is to make sure that somebody else looks over the loan estimate to make sure that your shoppable items are all in order, that you're not paying like $300-400 for a credit report, and you're not paying like ridiculous amount inflated fees. You're not paying some stupid administration fees. You're not paying things that typically you're not supposed to go ahead and pay, or something that is very easily able to be negotiated. So hopefully this helped you out. Until next video, guys, I really appreciate you watching. Peace.